Join me now here at the big board is Jessica Inskip, Director of Investor Research, stockbrokers.com. Jessica, it's always good to see you, whether in person or virtually. So you say the market is rallying on three key pillars. One, I want to know what you see those three key pillars as, and then I've got to follow up on that.
Sure. So the three key pillars are an easing Fed cycle, earnings growth, that's very, very important, and strong economic conditions. Those are the three pillars that were holding us off. And it's like a stool. If something falls, it causes the market to fall. And we saw that where the Fed still stayed in their easing cycle, but it was a little more of a hawkish cut. We are putting the risks more towards unemployment, even though there's still inflation risks there. The dual mandate is competing with each other, which puts us in this very uncertain situation.
It makes me think, I like your analogy because I picture a stool. You know how sometimes a stool, like with one of the legs, it can get a little like shaky.
Exactly.
Like I have this little stool in my shower and I know I need to like fix one of the legs because it's a little shaky. Are any of those three pillars that you see a little shaky?
Just the Fed easing cycle is a little shaky because it's a challenging environment. The big concern is, will tariffs spark more inflation?
Right.
But now we have this K-shaped economy. And I argue if we were to look at COVID and what caused that in the previous recession, not everything is in the same lane.
Right.
So we had supply chain issues, we had fiscal stimulus, we had monetary policy that didn't act quick enough. All of that resolved at different times. And so the economy, it's like portions of it are resolving at different times as well, and the earnings cycle is doing the same thing.
Yeah, I was talking to one of the guys on the floor yesterday. One of the things that he was noticing was that one, you know, when we lost some momentum at the beginning of the week. We gained some ground yesterday. Obviously, the bulls like that.
Of course.
But he was like, "What's changed? Like, what's different?" Especially with the questions about valuations. Is it just kind of resuming that typical pattern of November? And is there, you know, should we be bracing for another shoe to drop?
Well, it's great earnings, and the market, in my opinion, moves on earnings potential, period, because it's a bunch of companies and we want to see them grow. That's how we have good. And everything else is an input into that equation, and it's that input of the equation that we're assessing. We do have good earnings, and we have broadening earnings as well, but slow. That's good. I want to see slow. What I am concerned with is what's happening within the credit market. And so the standing repo facility, something that was implemented in 2021 due to what happened in 2019 with money markets in order to backstop that. There is a lot of activity that's happening within the repo market, and that's treasury bills. That leads into the deficit. And so that goes into fiscal implications and having more of a deficit. Bessent hinting that we're not going to issue too much on the front end of the curve, not T-bills, which Yellen was doing. To get the front end of the curve because it's shorter and we're going to think we're going to have lower interest rates on the front end. But if there's a bet that we're going to do it on the longer end, that's out of the Fed's control. That's what concerns me, is if we're going to issue or say we're going to issue longer dated treasuries, securities to finance our debt. If market mechanics are sending yields higher like we have seen due to growth concerns, that could be an issue. Okay,
so that's something to watch out for, potential speed bump.
Yes.
Let me ask you this. AI has been kind of the central theme for the past 3 years, honestly, now, and the explanation for everything.
It is.
The tech giants doubling down on spending. For retail investors, as you know, a lot of our audience is retail investors. How do they separate genuine, long-term, it's a loud drop over there, AI opportunity from hype, you know?
So I think it's very difficult to measure how AI has translated into positive revenue for companies that don't have direct exposure. So I'm talking outside of NVIDIA, those are the chips. But I think it's interesting if we pull revenue per employee, we can pull that. That's actually
I saw your chart on that. I was like, what is this?
Exactly. And so if we look at the JOLTS data, so it's this very interesting environment where we have no hiring, no firing, yet productivity is surging. We have this stable employment with rising outputs, and that has to be artificial intelligence. Now, I spent a lot of time talking to retail brokerage firms, and they've stated how they're utilizing artificial intelligence internally just to speed up compliance processes, put out more content. That is very difficult to measure, but it tells me, going back to how markets move, you can do more with less, which means we don't need to hire more people, but we can still do more and create more earnings and grow as a company.
So this next question I have may be a philosophical question, because it's
this.
something I've talked about with one of my colleagues, Alex Coffey, about this, because he's had this question. And, so like, okay, companies becoming more efficient with AI, right? And as you mentioned, do more with less. Great for the company. So, but then you start seeing layoffs, and we're seeing, in some of the jobs data, they're saying some of this is because of AI, right?
Yes.
But then, if you don't have the consumers working, who's going to buy all this stuff?
I agree, and that is this curious labor market dynamics that we're talking about. We have fiscal policy, which is pulling out some supply from the labor market, which does also pull out demand from the economy. That's just a factual statement there. And I do agree in the longer run, we do need consumption. The whole point of artificial intelligence is, like you said, increasing productivity so we can do more with less, have more targeted ads, and we need people to buy that. But we have the high-income consumer that's holding up the entire economy. So we do need an easing Fed cycle to give relief to that lower income cohort so we can bring them back up. But I do want to argue for Amazon, for example. They announced large layoffs. We say it's due to artificial intelligence.
That's right.
But I don't believe it's not necessarily due to artificial intelligence as in we are utilizing artificial intelligence. It's more, this is a department that we can get rid of and we need to raise cash to invest more and increase our CapEx spending to invest in artificial intelligence, which actually is arguably a little bit more of a concern than using it. But I think we have to think about all angles, and we have to understand. I like to use the analogy like my air fryer. I don't understand my air fryer.
How it works, but it works.
Exactly. I've got juicy chicken. It's crispy. It's happening. So it's just, if we don't understand it, that's okay, but we need to take in all the data and consider all angles.
And then let me ask you about the Fed and where you think the path is from here for December, because it's, it's not 100% clear, obviously. It was highly telegraphed, this most recent meeting in October, that we would get that cut. And the expectation going into that was that we'd see another one in December. But that's not a foregone conclusion based on how Powell spoke. Do you think the conditions are there to see a cut in December, or is it still, or do you see it like Powell sees it, as we're in a bit of a fog with the data?
Well, and I love the analogy that he used, as we don't have information. If you're in fog, you can't see everything. We start to slow down. But he has talked about alternative data before we had a government shutdown. And we still have that alternative data. And if we think about government shutdowns that have lasted a long time, pre this information consumption era, we did not have access to even poly markets to understand, and prediction markets, but all the state data that is aggregating, ADP, looking at MasterCard, listening to earnings. So I do think a rate cut could be on the table for one reason alone, is corporate earnings are going to give us our best insight to the consumer, and I believe that even before we had the lack of government data. And from even Chipotle, we hear how the
and Cava recently,
the lower income consumer, and there is
and McDonald's.
That's a concern. And that to me is valid reason to cut. And I think he's being cautious with his word of mouth, because that is a tool. And if he said, yes, race cuts next, we could have rallied.
He's not going to do that. Powell would not do that. He's never that way.
Absolutely. But that would have spurred very much of a rally. Then we would have gotten overextended and overvaluated, and I would have been more concerned with that. I like his cautious tone, and I need him to remain cautious. Wear that purple tie, Powell.
All right, purple tie, Powell. Thank you, Jessica. That is Jessica Inskip, Director of Investor Research at stockbrokers.com, and also the Market Maker podcast.